Pushkar, I believe a lot of us hear humdrum and noise around startups and angel investing, and quite a few of us wonder that how do we start this? So, how does an angel investor typically start his or her journey?
Hmm. That's a that's a good question to start the series, Vivek. So usually angel investors are wealthy individuals who invest in startups. These are usually the first investors who invest in any startup. So let's say I'm a founder. I have this brilliant idea that I want to build, say, an online marketplace of fashion or something, anything. Now, as long as it's an idea and I'm still building the product, there is no revenue, there are no transactions happening. Excuse me. Now, most likely VCs won't invest in my startup because most VCs like to see some traction, some revenue before they invest in what is known as product market fit. So they want to see early signs that the product I'm building and for the market I'm building it for, they have some semblance of fit. So at least in India, we have very few very early stage VCs, what we call pre-seed or seed VCs, who invest before the product is ready. So as a founder, I have two options. Either I use my capital if I have saved it over the years, or I approach angel investors. Usually, angel investors, the first angel investors are the people who know me. So, my friends, family, ex colleagues, former bosses, or there are hundreds of wealthy individuals in India who understand startups, who have made a lot of money while investing in startups, or who are also ex founders. They are angel investors. They invest in pre revenue or pre product stage at an idea stage. So, this is what you call an angel investor. And they invest money in startups, of course, to make money out of it.
Wow, that sounds uh, very delightful to people who are looking to invest in startups. And just to make it less daunting, since Pushkar mentioned wealthy individuals, I think you don't just need to be wealthy, but yeah, if you are relatively well off, you can start investing in startups. Of course, there is a accreditation process in India, in outside India as well, like in US, where you have to be a certified or accredited angel investor to invest. But once you have that criteria fulfilled, you can invest. So, anyways, Pushkar, that brings me to the second question, which people often come up that how do we invest? So, how do people actually get started with investing in startups?
So, the key to becoming a good angel investor or a successful angel investor is finding the right startup. Now, let's say I want to become an angel investor. I have decided that I will put in 50 lakh rupees over next 2 3 years in different startups. Now, of course, I'm not a popular person. I'm not well known in the startup ecosystem. So the best startups can't approach me. So I have two options. Either I find startups or I find someone who knows startups, who has access to a lot of startups. So unless you are someone like Kunal Shah, who's a really popular founder, really popular angel investor, who gets flooded with dozens of deals every day, for you the best way is to either join some good syndicates through which you can invest in startups, or if you don't want to actively take part in startup investment, you can also invest in a venture capital fund. So, and then the VC will invest on your behalf. But if you want to take early stage bets, the best way is to join an angel syndicate. An angel syndicate is a group of individuals who invest together. Vivek and I at Premise, we run an angel syndicate where we interact with dozens of startups every week. We try to evaluate them and we try to see, all right, which startup, in our opinion, will do well in the future. And then we circulate that investment deal to all our investors who are part of our angel syndicate. So there are dozens of good angel syndicates in India. You can start by joining them. This gives you access to good deal flow. Otherwise, as a relatively unknown individual, you'll struggle to find the best startups.
Interesting, interesting. So that brings us to a few questions just following from that answer. angel syndicate versus a venture capitalist versus doing your own investing. So let's pick up the thread of doing your own investing by directly approaching the startups versus going through a angel syndicate, which could be a host of syndicates out there, like Pushkar mentioned, even Tremis. We at Tremis also operate a syndicate for early stage investors where we curate these deals and also invest our own money while also allowing others to invest with us. So, Pushkar, what are typically the advantages a syndicate would offer over you doing your own investments or your own digging and finding a startup and getting on board?
So there are dozens of advantages, but if you were to ask me like why should someone join a syndicate, I would say two. There are two reasons. One is a better deal flow. So as a syndicate manager, I have access to hundreds of startups that most likely an angel investor won't have. Why? Because I do it on a daily basis. This is what I do for a living. While if you're an angel investor, you have a full-time job or a full-time business. You can't take out 10 hours every day on reaching out to startups, speaking to founders, understanding their business models. So this is the biggest advantage of an angel syndicate. Angel syndicates are usually run by people who are full-time investors into startups. This is what they do for a living. So, as an investor, you get access to better startups because we, as syndicate managers, maybe evaluate 10 startups and then decide to invest in one. So, the basic check is there. And the second reason, what I would like to say is basic due diligence. So, as a syndicate managers, we run some due diligence, not a very exhaustive one, but saying, all right, the company is legit, the numbers, what the revenue the founder is saying, or the team, everything is right, proper. You can also do that. It just takes a lot of time. So you can't do that for all the startups that approach you. And if you join an angel syndicate, you outsource that work to the syndicate managers. So these are two primary reasons, in my opinion, why you should consider joining an angel syndicate, especially if you're a new one, relatively new investor.
Wow, seems like a no brainer. If I'm starting out, I would rather play it safe by being with a syndicate. Now, of course, we invest either via syndicate or via uh, a group of friends or on our own. I think largely the motivation behind investing is to make money. Of course, people will invest for other reasons as well, which could be keeping themselves abreast of new technologies, being passionate about the ideas that they're backing. It could also be a way for them to be closer to the innovation network or be close to technological advancements. But I believe we will touch more on the primary reason why people invest in startups, which is the financial. So, Pushkar, when I invest money in a startup, how do I make money as an investor?
So usually, like when you invest in a startup, you buy shares of the company. It's like saying buying shares of any listed company on stock market. And then you wait for the company to become more valuable, what we call valuation. So as the valuation of the startup increases, now the valuation increases because of multiple reasons. The startup is growing, the revenue has increased, the market has changed, and then the value of your share also grows. So it's like buying shares of a company and waiting for the value of that share to increase so that you can sell it to someone else. So this is how you make money. It's very similar to so buying shares in a startup is called private equity because these shares are not listed on a stock exchange. Unlike public equity or listed shares that you can just go and buy on NSE or any other stock exchange. The big difference is since these shares are not listed, you can't sell them whenever you want because there is no liquidity. They are quite illiquid instruments, illiquid shares. So say you bought share in a XYZ startup at 10,000 rupees. Now the startup has done well. The valuation has increased 10 times. Now the value of your share has become 100,000 rupees, one share. Now, if you want to just sell it at that moment, it's very difficult because there are no buyers since the shares are not listed on any exchange. You have to find a buyer. Now, there are certain companies who are trying to build a marketplace for startup equity where individuals can transact startup share, but they are still in their infancy. So, as a angel investor, if you're investing in startups, what you should be aware of is that you can't sell these shares whenever you want. These are illiquid shares. So you have to wait for either a buyer to turn up, or you have to find a buyer, or you have to wait for some liquidity event.
Got it. So, which means that illiquidity is one of the main characteristics of startup shares, and we cannot really hope to get liquid money as and when we please in return for those startup shares that we hold. So, Pushkar, if illiquidity is such a critical component of these investments, so what do you generally advise to people starting out? Like, how should they build a strategy around it? What kind of money that they should be investing uh, out of their total financial allocation or their financial net assets?
Right. I think that's an excellent question because most people ask us is, hey, how much money should I invest in startup? Now, startups are risky and they're also illiquid. So our advice to all our investors is you have a full-time job or a full-time business. Let's say you have maybe a house or some real estate. Now you have 4 5 crores of, or say 2 3 crores of liquid capital that you can invest in different asset classes. You can invest in, say, fixed deposit, a commodity like a gold, or if you're into financial derivatives, options, or you can also buy it invest into listed equity, and of course private equity like startup. So the rule of thumb is it should be between 10 to 20% of your liquid asset into startups. Private equity in general, startups are a part of private equity. Now, this depends upon your risk appetite. Since these shares are illiquid, they take a slightly longer time to give return. If you're younger, if you're say 25 or 30-year-old, you can invest 20% of your portfolio into startups because you might not be needing that money quickly. But if you're in retirement or if you're in your 40s and 50s, you might have some liabilities coming up soon. Our advice is invest maybe 10% of your portfolio. So the broad rule of thumb is 10 to 20% if you don't do it for a living. For people like us who are invested in startups, like who work with startups all day, which is our full-time job, our allocation is obviously higher because we understand the risk and this is what we do.
Well, that's a lot of, I believe, clarity on startup investing and how illiquid the assets are and what kind of allocation one should be looking at. So there is a question from Parth that should we define a lower limit of investment account for a person to be called angel investor? So, Parth, yes, the investment platforms which are certified in India, they do have a lower limit. Some of them define their own limits as well. The lower limit is generally 1 lakh and plus. For Angel List, it's 3 lakhs and plus, and Angel List is one of the most popular ones. Kavi also asked question that does Tremis have a platform like Angel List or Invest? So no, Kavi, we do not have a platform. We just have a syndicate. So the syndicate still is dependent on our partnership with these platforms, and largely we are partnering with AngelList in both India and in US. So, anyways, that's to do with a couple of questions which came in between. So, Pushkar, also help us understand that when you say the exit event or liquidity normally can happen by people buying your shares or by IPO or other things. Typically, what is the time frame that I should be looking at if I invest in startups? When can I hope to get my money back, if at all?
Yeah, I think that's a good question, if at all. So most likely you'll have to wait for a few years to get your money back. So what used to happen earlier was a company like you started a startup, you raised some venture capital, you did well, you raised some more, and then you listed on a stock exchange. So listing on an IPO is the biggest liquidity event where the shares become liquid And then you can just sell to anyone. Like there is a market, there are buyers and sellers. If you own a share, you can be a seller. Now, what has happened in the past few years is since there is so much more private capital into the system, startups are staying longer. Startups are staying private for a longer period. So now it can be as long as 10 to 12 years before a startup becomes public. Most angel investors don't wait so long. So usually, for an angel investor, if you invest in very early stages, the liquidity event could be there is a bigger VC who comes and buys your share, or your company gets acquired. So there's a larger competitor that acquires your company in 4 5 years, and then you get your investment multiplies. You get 10x, 5x, 20x, depending upon the acquisition value, the sale value. But the most common way most angel investors still get an exit is when a larger investor comes and buys their share. It's called a secondary transaction. So a primary transaction is when a startup is issuing a new share because that money is going to the startup. A secondary transaction is when, as an investor in the startup, it could be a founder, it could be any shareholder in a startup, sells his or her share to a different person, to a different investor. It could be a VC fund, it could be an individual, it could be anyone, XYZ, family office. That is a secondary transaction in which just the share changes hands. The simple corollary is if you go on a stock exchange and on a listed company, if you sell the share of a company or buy a share of the company, the money doesn't go to the company. The money goes to the seller of the share, and as a buyer, you get the share. This is an example of secondary transaction. So, as an angel investor, you will most likely your exit scenario or a liquidity event would be most likely a secondary transaction where a larger investor or larger VC, 2 years, 3 years, 5 years down the line, comes in and buys your share. It usually happens just to answer your question about the time frame, like how long if I'm an angel investor, what kind of time frame I should be looking for. So in India, usually it's between 3 to 5 years. If the startup does really well and the valuation increases by 10, 15 times in 3 years, then an angel, larger VC fund will come and buy you out, buy your shares. It gives you an offer. Now it's up to you if you want to sell or don't want to sell. Or if the growth is slightly slow, but the startup is still successful, it could be 4 years or 5 years.
Fantastic. 3 to 5 years is not bad if I cling on to that word that Pushkar used, 10 to 15x. So we'll come to that. There is a question by Anusha again, who's asking that is there a minimum amount that the syndicate with Tremis Capital requires? So Anusha, it's very dependent on the deals that we do. Normally for India, it's between 5 to 7 lakhs. For US, we keep it around 7,000 to $10,000 depending on the investment opportunity that we are running and how much allocation have we got, which we would of course touch upon later in one of our questions as well. How does allocation work and how do syndicates work in the actual process of investing money? So I'll come back to what Pushkar touched upon during his answer about the time frame 10 to 15x. So Pushkar, that's a very decent return. So if I'm investing in startups, what kind of returns can I expect over my invested capital? I understand that some of them might not do well, but overall, what kind of return am I looking at?
That's a tough question to answer. So usually startups are like listed equity, I would say, are a high delta game. So how do I define high delta is either your money becomes zero, or if the startup does well, you make 10x or 15x on return. Now, when you're investing, you don't know which startups will do well, which won't do well. If you had that vision, like you would be just buying lottery tickets if you could predict the future. Unfortunately, we can't predict the future. So what we do is we invest in a lot of startups. Let's say we invest in 10, 15 startups. And then out of those 10, 15, it's very likely that 7, 8 won't do well and they will just die down. Or maybe 10. Two-thirds will just die down. Two or three will just return our capital or give us a 2x return because some larger company will acquire them. And then the remaining two or three, maybe like your 10 to 15% of your portfolio, will give you a 10x return. So on an overall portfolio basis, that if you invest in say 15 to 20 startups, The return you should be looking at is, I would say, 2x of your money in 3 to 4 years, maybe 2.5x in 5 years. So at Premise, we have an internal benchmark where we say we want to double our investors' money in 3 years horizon. That comes out to be a 26% IRR. This is pre-tax, of course. You'll have to pay taxes on that, but there's the number we look at. So anything above, so see, if you invest in private public markets in India, you would be making something like 14-15% return every year on an index fund, depending upon which year did you get in, but on a long-term basis, I would say 13-14% is common on a pre-tax basis. Now, if you're investing in startups, they're also illiquid because you just can't sell the share whenever you want. You have to wait for a liquidity event. So you attach a liquidity premium on that. So that liquidity premium could be say 5-6%. For some people, it could be as high as 10%. Some people, they're fine at 3-4%. I'm saying on an average, let's say 5-6% liquidity premium. So anything above 20% annual return on your portfolio is a good return in a startup.
Yeah, that looks like a good IRR and a good return on the money invested. I just also would pick on one of the points that Pushkar made, that 10 to 15% of your startups might be returning the best part of the capital. So that brings us to the question that I should not be, or rather, one should not be just investing in one startup and hoping for it to work. Pushkar, do you advise putting a portfolio together and diversifying your investments even as a starting angel investor?
Yeah, of course. I think there is a lot of wisdom in diversification, like the age-old proverb that not to put all your eggs in one basket holds especially true in startups. So, say I want to become an angel investor. I'm just starting out on my angel investment journey. Now, the first thing I should do is I should make an investment plan. That all right, over next 2 years, let's say I have a 2 year horizon. I say over next 2 years, I want to invest 1 crore rupees in startup because I think my liquid wealth over next 2 years will amount to something like 5 crore rupees. I want to put in 20% of that in startups. Now, I just can't put this 1 crore in one startup or two startups. That's a recipe for disaster. Most likely, I'll lose money. So, what I do is I equally allocate this 1 crore across 15 or 20 startups. So, let's say I make a plan of all right, over next 2 years, I'll invest in 20 startups. I'll put in 5 lakhs each in every startup. Now, why you should put equal amounts in every startup and why not unequal amount is because when you're putting in money, when you're investing in a startup, you don't know which startup will do well and which won't do well. At the start, when you're investing money, all startups have an equal chance of giving you a 10x return or becoming zero. So let's say you put 50 lakhs in a startup and that startup didn't do well, while you put in 5 lakhs or 10 lakhs in startups that eventually did well. So your overall return will suffer. You won't make 25-20% return on an annual basis if you invest in startups unequal amounts. So that's why there's a lot of wisdom in saying that, all right, invest in a lot of startups and invest same amounts in those startups, at least in the first round. A lot of investors and a lot of VCs, what they do is they invest more in the follow-on rounds. Once the startup has become larger and it's raising a fresh round of capital, then they invest more capital. But at the start, when
Great.
you're making an angel investment plan and you say, hey, I want to invest in 20 companies, our advice is invest equal amount. Decide on amount. This could be as low as 1 lakh rupees or 2 lakh rupees. Need not be 5 lakhs or 10 lakh. Depending upon how much money you want to invest, if you want to invest, say, 20 lakh, let's say you only put in 1 lakh rupees in every startup and you invest across 20 startups.
Great. That means that diversification is the key rather than getting swept over by a startup pitch and sort of putting all your eggs in one basket. It's best to wait and avoid what we call fear of missing out or FOMO. Even the best of investors are sometimes not immune to it. Uh, while it's easier to say, but I think it's best to avoid the FOMO and try to diversify your investments over a range of startups, putting equal money. and probably allocating only 10 to 20% of your capital. I think, yeah, these are great lessons for the first time investor. One more question which hits my mind, Pushkar, and it would be great to dwell on that, is that when we are taking an exit from a
Hmm.
startup in terms of secondary shares, normally I have heard that it's a very catch 22 situation. So the startup which normally does well would be the one to eventually offer you more secondary opportunities or more opportunities of exit, while the startup where you think that liquidity is going to be very, very unlikely, long term growth looks super difficult, that's where you will find even any sort of opportunity, even a partial return of your capital, even that kind of opportunity, very difficult. So, Pushkar, what do you advise when I invest? Should I just keep that in mind that the next 5 to 7 years I should not expect any return, or I should be ready to take a partial return? What do you normally advise from your experience?
I think you called it right, Vivek. It's a cash 22 situation. So, because the companies that are doing well usually offer you secondaries, and the companies that are not doing well, it's very difficult to sell those shares. So, what we advise is, let's say you invested in a startup. Now, the startup is a unicorn potential. It can eventually do an IPO and give you a 500x return or whatever, 100x return. The kind of return people made in Amazon, Uber, these kind of companies. Now, those investors are very rare. As an early investor, our advice is if you're getting a 10x, 15x return, take it because that's a lot of money. And that will also give you a lot of validation to invest more into the startup because eventually it's just hypothetical money. You don't know if the startup will IPO or not. There's also a risk that it might fail after raising $100 million. They have startups that have failed. So if someone's offering you a 2x return or a 3x return, maybe it's not a great, like, maybe not it's a great multiple to take that return. You can just hold on for a bit. But as a first time angel investor, if you're starting out your angel investment journey, my advice is 10x, you take it. So if there is a larger VC who is coming and say, hey, like now the valuation is increased by 10x, I can give you a 10x return on your initial share, initial investment. You can of course say no. They can't force you because you are a shareholder in the company. You can say no, I'll wait until the IPO. That's totally fine. But you don't know how long is the IPO. And maybe you might end up antagonizing the founder because the founder wants that investor to come in and the investor needs to buy your shares because of XYZ reasons. There are different reasons that maybe they can discuss in another event. So, what will happen is in the future, the founder will stop offering you such offers, such liquidity events. So, then you're stuck. You have to wait until the IPO. There's no other way. So, and all founders also realize that if someone has backed them as an angel investor in the early stage, it is their job to make them money. So, as a founder, they won't force you or they won't ask you to sell your share at 2x or 3x because usually you don't invest for such small return in a startup unless it's an acquisition where it's fine, where you can't help it, the company is being sold. But if it's a 10x, 12x, 15x return, my advice is just take it because that's a lot of money. And then you make a lot of money on your portfolio level.
Well, so sanity lies in cashing in when the opportunity is knocking on the
Yeah,
door,
cash flow is the thing.
because these opportunities, yes, so the opportunities don't knock often enough in the world of startups, and even less in the world of startups these days. Which brings me to just the last point of discussion before we close on this, unless there isn't any other question from the audience. So, Pushkar, increasingly we hear there is a funding winter around, there is dearth of liquidity for startups. Should I, as an angel investor, look to invest during a time like this, or should I wait for the climate to get better and probably invest when the startups are flushed with liquidity?
That's quite an interesting question. So there is no right or wrong answer. There are, of course, two lines of thought. I believe, like in times like this when raising capital has become difficult, the valuations have also come down. So it's a good time to find best startups at decent valuation. Now, what happened in 20 and 21 and first part of 22 was since there was so much venture capital into the system, the valuation just went skyrocket. They just skyrocketed. And then startups were raising capital at 50x, 100x of their equity, which is, of course, not sustainable. Historically, that was an extremely high valuation multiple. Now, those numbers have also come down. And of course, founders have also realized that they can't raise capital at that high valuation. So, sanity has prevailed. So if you're starting out, if you want to start out as an angel investor, if you're starting out on your journey right now, is the best time because you'll find attractive companies, good companies at attractive valuations. And eventually, in 2, 3, 4 years, by the time the startup grows well, the venture, what we call this funding venture, should be over. There should be more capital into the system. And then these startups can raise more capital. It might not go back to the 20 or 21 days where startups were raising capital at 50x valuation. But still, things should improve from here on. So there's also always a lot of merit in buying at the bottom, what they say in the stock market. Like in stock markets, you can never catch the bottom. So a lot of people can also think that, oh, but the valuation will continue to crash. I should wait till 2024 when the valuation's at a peak, as in at the rock bottom, and then I'll buy. Of course, you can do that, but you don't know whether the valuation will keep crashing or will they start increasing from next year onwards. Right now, valuations are at a historically low multiple. It's a good time to invest because in 3, 4 years you'll start seeing higher valuations and you'll make a lot of money.
So to add up to what Pushkar says, there is never a wrong or right time, but right now looks like it's going to be a time when angel investors can get in and make some money over the next 3, 4, 5 years. Having said that, this podcast or this series of conversations is not meant to be investment advice of any sort. So do it after your own diligence. And of course, just to remind everybody, we are also coming up with an angel investing workshop from first week of May, which will bring a series of workshops around the nuances of investing, understanding the nuances of investing better. It's a 6 week workshop and it's going to happen on weekends. So it's a 90-minute Saturday, well utilized for those who are wishing to start their journey in angel investing. We would look forward to see some of you there, and it's going to be quite enriching one-on-one case study led insightful discussion. So with this I will wrap up today's discussion. Thanks so much, Pushkar. It has been very, very insightful.
My pleasure. Thank you. Bye bye.